Hello, everybody. My name is Matthew Wright. I am a senior finance student at WVU, and today in this session, I'm going to be going through the SCORE financial projections spreadsheet, and I'm going to be explaining some key factors in it, and going through each sheet in that, and kind of giving you all an explanation of what's going on. So, here we're going to start on the directions page. And so, your very first thing that you want to do is you want to go through and enter your name. So for me, it would be Matthew Wright, company name. Let's just say Wright Stuff, and then starting month and starting year. That could be, December 2022, which is the current month and current year. So color coding. So, after you read these directions over here, you want to understand the color coding system because that's pretty important in this spreadsheet. So the darker orangish color right here, that's where you want to enter data. Not every single box is going to require it because your business might not have that specific aspect, and we'll get to that in a minute. But that should be a good indicator of like, oh, hey, I need to really look here. Like I should probably enter something right there. Um, and then the lighter color, the yellowish box right here, is to adjust as needed. And so a lot of that, there are numbers that are going to be already in those cells, and that's just going to be a good starting point for you or for your business or that certain line item, and you can adjust it as you deem necessary. So we're going to move to the starting point down here. And so right here, these are going to be your year one expenses. As you can see, this is your startup year. Your real estate, your land, your real estate buildings, all of these fixed assets, so right here we see the difference in those color coded boxes. And so the reason for that is, so let's just say you have a specific amount for how much each one of these assets is worth. You may not have any buildings, you may not have any real estate, any land, you may not have any vehicles for your business. That is going to be determined by the specific business that you are running and what all assets you have for that. And so those numbers are going to be entered right here. If you don't have any, you can just enter a 0. That's completely fine. And they'll be totaled up down here. And so when we get into the lighter colored boxes over here, you see that it's under depreciation. And so this is just a good starting point because, buildings are typically depreciated for 20, 25, 30 years. And then things like equipment, furniture, vehicles, other smaller kind of fixed assets are usually depreciated for a shorter time. So like 5, 7, 8 years. And then we move down to operating capital. So a lot of this stuff is going to be things that, you are going to determine. It's really going to vary by the type of business that you run. Do you have rent deposits? Do you even have a place that you're renting out? Are you renting it out of your home? Advertising and promotions, what does that first year look like for you? Those sort of expenses and line items are going to go in these boxes. And so right here on working capital, you see our first little note in our boxes. And so you see that as like a red cut out of the corner. And there are several on the sheet that have that. And so, if you have a question, generally it's going to be answered in that little note box. Okay. And then sources of funding. So every business needs some source of funding to get started. So whether that is you putting money into it, you asking from a loan from your family, from an outside investor, a rich guy down the street that you might know that would give you a loan to start up a business that you really think will be successful. So you're going to enter those here, and then your loan rate right here. So these are just average interest rates for each specific item. So like for a loan, for a mortgage, for your credit card debt, vehicle loans. A lot of people, I'm sure, are familiar with how a vehicle loan works. Typically, it is around 6% interest for 48 to 60 months. And so you can adjust those as you deem necessary. If you have it for 60 months or 72, you can enter that here. And if you manage to get an interest rate of 4% or 5.5%, you can adjust that in this box. And so what all of these are going to add up to is later on in the document, we're going to look at our loan amortization and depreciation schedule. Actually, we can just take a quick peek at that right now. So there's a link that if you click on, will take you directly to that tab. And so right here, since there are no colored boxes in this tab, all of this stuff is going to be calculated for you and broken out. And so if we were to go back and enter a commercial loan for 500,000, then we can go to the depreciation and amortization schedule, and that's going to show you the payments that you're going to make on that sort of thing, how much is going to interest, how much is going to principal, and then your yearly totals. And obviously you can change that to more than just 12 months. But that is just going to depend on your situation. All right. And so then moving on to payroll year one. So this is a very important part to pay attention to, because a lot of people forget that when you run a business, you've got to pay yourself. You are a worker, you're putting in time, unless you are just hiring other people to take care of everything. More power to you if you are, but you are most likely going to be paying somebody for their work. And so, number of owners or employees, that's entered right here. How much you're paying them per hour, and then how many hours they're working a week. And so once you calculate all that out, so let's just say we own our business and we pay ourselves $15 an hour and then work 30 hours a week. And so that is going to break out each month how much you're paying yourself and your annual totals. And so the reason that these are orange, and you can adjust them as you seem fit, is if you think that you're going to end up working more down the line, you can actually increase how much you are paying yourself. So if you think in month 6 things are going to really speed up, you're going to have to start working more. You can say that you're paid $3,000 a month now, and you're increasing your salary or how much you're getting paid. And so that's going to roll over to the following months on that. And you can see down low, there is a percentage of your salary wage that are certain taxes and benefits are taken out of. And the reason they're yellow is, if that sort of rate goes up or changes over time and you still have this document, you can adjust those as that rate adjusts. Okay, so let's clear this out. And then we will go to payroll years 1 through 3. And so this is a little bit more simple than the previous tab. As you can see, we're kind of entering each sheet on the bottom here, and then usually it's followed by that same sheet, years 1 through 3. And so that's just in relation to your growth rate, how much you think your business is going to grow, how much you think each specific line item is going to grow. So do you think that you are going to end up paying more for your full-time employees because you think you're going to hire more, or you think your current employees are going to end up working more hours? That sort of expense. So this is just to determine how much those items are going to grow year over year. Sales forecasts. This is where you're going to break out your specific products. You go to the units, or you enter your units and product lines, then your sales price per unit. And my recommendation would be to calculate your cost of goods sold first. That is pretty important, because you got to know how much it takes to make your product, before you determine how much you're going to sell it for. So if you click on here, it'll take us to our cost of goods sold calculator later in the document. And so here you can enter all of the necessary information to calculate that cost of goods sold number. And so right here we can enter how long the time frame is and your product line, and then your raw materials. So how much it's going to take for you to make your product. So like if you're baking a cake, you're going to need to buy eggs, you're going to need to buy flour, you're going to need to buy sugar, all those different ingredients going into your product. And then your labor used to produce your product. So if you're making it yourself, how much you're going to pay yourself. Costs associated with shipping and storing, production facility expenses. A lot of those have to do with if you're outsourcing the construction of your goods. So if you are working with a bakery and you are going to be the sell side of the bakery, and they are just they are making the goods for you. A lot of that is going to be, a lot of these numbers are going to be given from your supplier. So like how much they're going to charge you for your how much the shipping costs, excuse me, and how much it costs to buy all those raw materials and such. And then so then we go back to the sales forecast right here, and you can enter those numbers right here, and then you can determine. So like if it costs you $5 to get all the raw materials, or to make a cake, it costs you $5. Let's just say you want to sell a cake for $8, and so on each unit you are making $3. So that is your margin per unit. And then here you can determine how many. Let's just say we're going to sell 30. Or I'm sorry, this is where you enter not the number of units. This is where you enter the plural form. So like we would say cakes here, and that's going to differ, that's going to differ from line item to line item. So like if you're baking cakes, muffins, all different types of cupcakes, anything, your different product lines. Okay. And so let me back this out. Oh, okay. So then we move to sales forecast years 1 through 3, and it's the same thing as earlier with our years 1 through 3. It's a little bit more intricate and detailed than before. And so you see those growth rates year over year right here. And so you can change those as needed. And so a lot of this stuff is going to be entered. That's going to be entered from your different product lines from what we just did right here. And so that's just projecting those out onto the second and the third year. And so you can change those if you think sales are going to increase. If you think it's a seasonal thing, if you sell swimsuits, obviously the warmer time of the year is going to be more units sold than the colder times of the year. So moving on to the additional inputs, and here, so this is going to have to do with like your accounts receivables, your payables, things like that that you might have to enter. So like if your supplier is charging you on a tab essentially that you're going to pay every 2 or 3 months, let's just say, then you can enter that. So if it's more than 60 days, between 30 and 60, less than 30, you can enter all those little details here. OpEx year 1. So these are the expenditures that are going to keep your business up and running. So what does it cost to keep the lights on, essentially? So your advertising, how much advertising are you going to be doing? Your repairs and maintenance, if you need to get a new oven to bake cakes in, your insurance, your legal and professional fees, your licenses. Do you need a license or some sort of certification to own a bakery or to sell cakes along those lines? Your utilities, things like that. A lot of these line items, you can find by doing a little bit of research online or into the specific business that you're going to run. And so then rolling over into the years 1 through 3, same thing as we've seen earlier. Just how much do you think each specific item is going to grow year over year? Moving to cash flow year 1. So you have your additional inventory that you might purchase, any owner's distributions. And so this is a little bit different than, if you are working for your company. Distributions are how much you are taking from the equity or the net worth of the business. So how much an owner can take out and say, like, hey, I helped this business get to where it is now. I'm going to take some of this money and use it to buy personal things for me. So it's essentially another way of paying yourself. So moving on to years 1 through 3, you have your years 2 and 3 spread out here. You'll have your year 1 totals pulled over from the previous tab, and so you'll be able to compare year 2 and year 3 totals to those and adjust any of these items that you seem to or think should be adjusted. But you notice that it is a darker orange, so you will have to enter those if you are entering anything over in here. And so your income statement year 1, you'll notice there are no color-coded boxes, and that's because all of this stuff is going to be entered in for you. As you can see, a lot of this stuff we have seen in the tabs before. And so this handy dandy spreadsheet that we are going through calculates you can see all the different formulas that are showing up in each one. It calculates and pulls these from the other sheets that we've actually gone through and already entered data in. And those will actually come up in here, and you will be able to see your bottom line or your net profit or loss right here. And so then moving forward, same sort of thing. So your income statement years 1 and 3, since we've already entered all of those line items for years 1 through 3, you'll be able to see those first 3 years right here with the different rates that you see before you. And so your balance sheet. So your balance sheet, it is essentially an equation. That equation being your assets or things that you own equals your liabilities, which is stuff that you owe, plus your equity, which is essentially your net worth. And so that equation, the reason that we do it like the assets plus liabilities and equity is because it's supposed to balance. So when you add the assets up, it should equal the liabilities added to the equity. And so that equation derives from how you calculate your equity or your net worth. And that is because when you subtract your liabilities or stuff that you owe from your assets or stuff that you own, that is your net worth. That is how much your business is worth. And so a lot of other things are included under equity. So, such as retained earnings, how much your owners are, how much essentially the business is making, your common stock, which a lot of startup businesses are not going to have to worry about stock or dividends or anything like that. So your break-even analysis, this is another tab that's going to be calculated for you. As you can see, you can check that once you are done entering everything into the sheet. Financial ratios, same sort of thing. You can go through and you see this tab or this column labeled industry norms. If you want to compare your business to other businesses in the industry, you can actually go to find another business's financials, financial statements, and you can look up, their current ratio, quick ratio, debt to equity, things like that, and compare your business to theirs essentially. Diagnostic tools, this is one of the last things to look at because it is going to help you understand if you need to change numbers or not. If you read this over here, it essentially tells you that, it's going to tell you if your number is within a reasonable range of what the program thinks it should be within. And it goes on to say, no computer can truly tell you if you're correct or not. But it is a good place to start. So moving on, cost of goods sold calculator, we've already seen that. And then amortization and depreciation, we've already seen that because that is from our loans that we've taken out or haven't taken out from earlier. And then that is it, guys. So thank you guys for watching. I appreciate all the time. And if you have any questions, I'm sure that whoever referred you to watching this video is more than happy to help you.